let's move into munis, because as interesting as a bull steepener is on the taxable side, the muni curve is one for the ages. So,
yeah, I mean, 2025 was the year of the yield curve in municipal bonds. Munis are really attractive today. I think they're one of the most attractive opportunities across all asset classes. But how we got here is really interesting. So look at the left-hand side. Scott was talking about how treasury yields basically fell across the curve. That is not what happened in the muni market. 20, 30-year yields were up 35 basis points. Why were they up? Well, in the first half of the year, everyone was freaked out about the One Big Beautiful Bill Act. Would they cause municipalities not to be able to issue muni debt anymore? Because that was kind of original talks at one point. So that led to kind of a tale of 2 years. You can see on the right-hand side of the chart, the first part of the year, basically munis underperformed everything. Doesn't matter what it was. Q1, Q2, munis underperformed. It's because there was so much supply in the market and no one wanted to jump back into the market until they saw what the One Big Beautiful Bill Act looked like. Once it passed, munis were untouched. The second half of the year, supply was more manageable, and munis ripped in the third and the fourth quarter to a year that, 4.3% for the index is a pretty good year. It's kind of what the yield was at the beginning of the year. It's kind of what we thought returns would be at the beginning of the year. We just didn't think the first half of the year would be bad, and the second half of the year would be really strong.
I'm just going to let these next set of visuals stand on their own and take them away.
Yeah, I mean, the left-hand side, yields are really high from a historical standpoint. Tax equivalent yield of the muni index is north of 6%. Right, so just if you capture your yield and you get no price appreciation whatsoever for AA average index, 6% sounds pretty nice. So we think that's going to draw a lot of interest as people are looking to deploy cash. I'll point to the right-hand side of the chart for a second. The muni yield curve is incredibly steep. So look at the after-tax treasury curve. You get 40 basis points to go from 10 to 30 years. The muni curve, you get 148. I mean, that's an astronomical number to extend duration. And the reason for that, there was all that supply. People have not been ready to jump into the long end yet in munis, but we think that's coming. We think that as the Federal Reserve cuts interest rates, whether it's 2, 3, 4 times, the yield on cash is going to go down. Yield on cash is going to be close to 2% after tax. If you can get double that by extending duration in munis, we think a lot of investors are going to do that, and they're getting paid to wait. So even if you don't get the time right, you're going to get paid a lot of money on a tax equivalent basis just to sit out in the longer end of the yield curve.
And the flip side of that coin, if you are going to get that kind of a curve, that's because your longer maturities tended to struggle a little bit in the past.
Exactly. Yep.
And so there's for you to take a jump into that if you'd like to.
Yeah, it's just, I think portfolio positioning is so important this year, just like it was last year. If you bought intermediate bonds last year, you got almost 6% return. If you bought long bonds, you got 2% return. So that type of delta between intermediate bonds and long bonds is very, very uncommon. It just shows how unique of a year last year was, but it's also the reason why long bonds are so cheap right now. They underperformed, and they underperformed for good reason. But the one thing I think that's really important is on the lower right-hand side. Munis just aren't cheap on an absolute basis. They're cheap on a relative basis too. So long munis on an after-tax spread basis, you get more yield than you usually do versus treasuries. Short munis on an after-tax spread basis, you get more yield than you usually do than treasuries. What that means that if you build a barbell maturity structure right now, that you don't need the treasury curve to flatten for the muni curve to flatten, because things are cheap there. So even if the treasury curve stayed the same steepness it is right now, the muni curve, just by going back to historical averages, long bonds could really outperform.
Forgive us all for, as bond guys, for getting super excited about curve shapes and roll math and everything else. But again, that's 400 basis points, right? Intermediate by 400 basis points. And it's still present inside of the market. Sorry, please, if you would.
Yeah, I mean, I think there's a lot of fundamental reasons for long munis to do well. I think that when people roll out of cash, they want to lock in higher yields for the long amount of time as possible. So I think long munis do that. I think the curve is steep. I think muni investors are income investors. I think there's a lot of reason for munis to do well. But this just shows when you're steep from a historical standpoint like this, it usually doesn't last that long. It usually reverts back to more normal levels. And when it reverts back to more normal levels, long munis outperform. So whether or not you believe it from a fundamental basis, whether or not you just look at history and believe history is going to repeat itself, long munis should outperform.
I think there's a fuse to all of this. Eric's talking about as much as 4 cuts. We've been talking about this for a few years. When inflation was high, the level of treasury yields are booing everything. Like yields are attractive, but spreads are tight. Why? Because treasury yields are high. Yields are high at a high grade level. The question is the level of permanence, semi-permanence that exists there and whether or not you're going to get a hold of them before it comes down. I personally believe if it plays out this way, whether it's this year or next year, these yields disappear. But if we are inside of those yields now, then the capital gains that come from the declining rates is how we get compensated. So let's say that they don't come down and they just stay at attractive levels. Now you're just flipping attractive inflation-adjusted yields. Real income is real income. But by the same token, whether it's this year or next year, if they do come down, the way that you get paid off as they do is the capital gains on the other side. I've been saying this for a while. Manage duration now. Have a strategy to duration now. Understand the shape of curves right now and make sure that it's built inside of your portfolio. And yet, as much as I talk about that, I do love muni credit. So if you could hit the last slide.
Just one thing to add to that, right? I mean, when we sat here a year ago doing this, right? Overnight rates were above 4, 10-year was 4.5, right? So it really was not a lot of give to go to cash, right? Yield was roughly the same. Right now, as we're sitting, whether we sit in munis or taxable, right, that gap is kind of widening out, and if anything, probably continues to widen this year, right, as that front end rate. And so I think the jumping off just becomes like if you haven't jumped yet from cash into fixed income, right? Like start stretching.
And again, it's not super exciting ordinarily to talk about things like roll down math and shapes of curves, but that's real money that gets generated as a bond ages and comes down the curve. The steeper the curve, the greater the capital gain, all of that stuff. We should all be trying to channel our inner bond geek to take advantage of these shapes because they're not normal. And the muni reaction function in yields over the last year was historically abnormal. Muni credit attractive.
Yes, so muni credit is something that if you looked at the after-tax Sharpe ratio, and Rick has talked about this a million times, it's one of the best places you can invest in over time. There's just no doubt about it. The Sharpe ratio looks good. The absolute after-tax return looks good. Today, it looks even better. The tax equivalent yield of high yield munis is over 9%. I think if you thought about what's the expected return in a lot of different places, where are you going to earn 9% with a really good after-tax Sharpe ratio? There's probably not a lot of places to find that. At the same time, municipal credit continues to be strong. Rainy day funds across the country still very high. So a lot of cash on balance sheet. That doesn't mean that you can just buy it indiscriminately. There is a lot of sector dispersion. You can see that on the right-hand side. Last year, transportation didn't do so well, particularly because there's a couple of big issuers in the transportation sector that didn't do very well. And if you avoided those, you did great. Same thing with tobacco bonds. So you still need credit research. There still is policy uncertainty. There still is certain sectors that we think are going to do better than other sectors. So you absolutely need credit research. But as an asset class, the tax equivalent yield is really attractive. We think the Sharpe ratio is going to be really attractive. We think, again, as the yield on cash goes down, muni high yield is going to be a place that people put their money.
I will ask you just before we go to Q&A, and thanks everybody for hanging around for us. We always try to, get to all the slides within the hour, and we will stick around to answer as many questions as we can post the hour until they eject us from this system. But just quickly putting it together, the idea of the high grade and the high yield.
Yeah, I think portfolio positioning really matters today. If you position your portfolio correctly, you can get a lot of additional yield. We think a lot of additional return. So what we have here is our recommended blend of how you position a portfolio today. If you barbell a maturity structure and you add in some mid-grade and high yield credit, you get a yield of north of 4%. That's before taxes. And so you don't pay taxes on that. That's a tax equivalent yield of well over 6. And you compare that to other things like the index, like the 1 to 10 year ladder, like a 5 to 10 year ladder, and you're out yielding it by a lot. And I also think because the yield curve is so steep and short bonds and long bonds are so cheap relative to treasuries, I also think that means you have a lot more price potential upside by building a blend like this today. So this is how we'd recommend clients allocate their money.